Hello and welcome back to WealthLab. This is Saksham, and in today's video I am going to talk about the right time to trade, the right time to be aggressive or defensive, the right time to go all in or to sit on the sidelines. Most of us get it wrong. That is why we make a mistake that is avoidable. That is why our hit rates are lower. That is why we get frustrated. That is why we have a drawdown on capital. We need to understand where we are in the trading cycle, in the momentum cycle, to know if it is the right time to be aggressive, if it is the right time to take a step back. To explain this concept of when to be aggressive, when to go all in, I'm going to use two resources. One is going to be this small 7 slide presentation, the other is going to be a small article that I wrote that you can get on Substack. Uh, so let's start. So one of the very important things to understand is to understand the PE cycle of the index that you invest in or the broad market. PE is the price to earnings ratio. So you have to understand the PE cycle. कि हम PE cycle में कहाँ पर हैं, where do we stand in it, and how can we expect our further returns to be depending on where we are in the PE cycle. So why is this important? So P ratio, if it is low, means that there can be higher growth ahead, and we are priced for lower growth. That means there is value. The growth in the future is going to be more than what is priced in the equities, under value. When it is medium, the it means that it is fairly valued. The price and growth are same. When it is high, when the PE ratio is high, that means that we are already overvalued and we can see a correction anytime soon. So these three important points are there to remember about the PE ratio. Now, how do we know low, mid, high, whatever, etc.? Majority of us, I believe, trade in the Indian markets. That is Nifty 50 is the broad index that we track, and Nifty 500 or mid small 400 or small cap 250 or small cap 100 is what we minorly track. But the broad market is Nifty 50, so we can get a broad market sense and do the analysis. You can also do a minor market sense, or if a broad market is small cap, so you can use the same framework there. Now, in India, the average PE is 20. So, whenever the markets are below 15 PE, the markets are undervalued, and it is time to be very, very aggressive. We saw this back in the COVID fall, we saw it in 2012 13, we saw it in the global financial crisis fall in 2008. This is the time to be very, very aggressive, and don't even think about anything, just go all in. Look for breakouts, go all in, go all in, go all in, and everything you will be able to get a much higher return when the PE is under 15, because the usual growth rate is higher. We are undervalued. But this circumstance happens very rarely. It does not happen very often. We usually trade between 17, 18, 19, 20-ish PEs. 15 is a less seen number, only 5% of the times. So we usually trade in the fair value territory, which is 15 to 20. Sorry, it's written 25 here, but 15 to 20, 17, 18, 19, 20 is where we trade today. This is the median that is there. Over here, your VCPs, your stage 2 breakouts, this is what works. Okay, you can be aggressive, but not sell your house and put it in equities, or sell your other asset allocation, put it in equities aggressive. You can be aggressive, but not very. So the stance is more like neutral, that you're balanced, you are seeing your hit rate, you are seeing your performance, and then you are changing it. It will be 20 over here and not 25. So you will see all of those things and then act accordingly. That is when you are between 15 to 20. You can use WealthLab, RS analysis, stage 2 analysis, VCP, sectoral tailwinds, etc., etc. during this time period, when the PE is between 15 to 20. Whenever it is above 22, 23, 25, we cannot sustain those levels. When the PE is that high, that means the market is in euphoria, the prices have gone up for a very long period of time, and they are bound to come back sometime soon. That is the late stage of the cycle. Even 23, 24, 25 will be an overvalued market, and this is when PE is over 25. At this time, you have to be defensive. You have to reduce your equity exposure. You have to sit in cash, bond, defensive sectors, gold, silver, equities, etc. Gold, silver, metal, not metals necessarily, gold, silver, or other safer assets than being equities when P is above, it says 25, or it should be 22, 23 is also a overvalued number in Indian context. This is the time to be protective. So three phases. When it's 15, go all in. Don't even think. When it's between 15 to 20, 22, then you have to trade strategically. Whatever you read in the books, in Mark Minervini's or in Stan Westein's or William O'Neill, whatever you read, whatever your strategies, whatever your framework is, you follow that. You follow that with heart and soul, and you will get good results. When you are above 22, that then it is time to stay very very defensive. Sit back, protect your capital, don't try too much, your hit rate will be low. uh, when the markets are overvalued, very good nugget over here, when the markets are overvalued, take very short term trades. If you want to take 3 days, 4 days, 1 week, 2 week, I'm not someone who can do that, but if you are someone who can do that, then those markets are very good for short term trades. This is because everyone is involved in the market, so the moves are very wide. You get more percentage, more risk returns, you get wider trades in these environments. So at when the market's overvalued, it is better to stay closer to the exit door. Your hit rate will still be low, but it's better to stay closer to the exit door than the entry. All right. So the complete P cycle looks like this. We are sometimes at the bottom. This is where you have to do aggressive buy, aggressive buy, aggressive buy till 20. Once it's above 20, you have to uh, reduce, be defensive, take lesser trades, take more 5-star trades, more quality trades till the time it becomes 24, 25. And then at 25, I don't think there's the right time to even trade or even try to trade. Just put your money in a safer asset, wait for the markets to correct again. And once it starts to correct, it has start to go down. Right now we are at 19. We might go to 15, we might not go to 15, we might go end at 19, we might go to 17, whatever is the case. This is where you start being aggressive. And then again. So be aggressive, take more, sell your house, not sell your house, but take more trades, take selective trades, don't take trades, don't take trades. Take a lot of trades, take selective trades, don't take trades. And this is how the whole cycle is going to move. And to help you with this cycle, we have built WealthLab to help you with RS analysis, stage 2 analysis, fundamental analysis, bring all the data together and make you the best watch list, the best portfolio that you can build for your equities to outperform the market. That is where WealthLab comes in. But you need to know when to be aggressive, when to be at the right spot, when to time your equities, when to put in more money, when to not put in, and when to take a step back. That is what it was all about. To help you with the same, we wrote an article on the most expensive mistake in investing is free to make, and most of us make it repeatedly. Over this article, I will take you through it right now. We covered a few data points, and I will take you through those data points. So, case study one is that uh, during the dot-com peak in 2000, we peaked here, and it took a lot of 6 years or 5 years for it to recover. Peak of the cycle, this is bottom. This is where you have to be very aggressive. After this, you have to still, after 2005 there were 3 years, and 2008 we again had a crash. So then it was 2008 financial crisis. So this is where it went up, and again 2008 we had a crash. Okay, so the peak was hit. If you check the PEs over here, you will see it will be really high. I will show you as well. And then this is the time to be trading, to be investing more capital, to be more aggressive with your capital. So I will just show you. So whenever you have someone has invested below the PE of 15, the average 3-year returns just in investing, not even trading, has been 30%. But this is very rare situation. In 15 to 20, 25% of the times, the average is 15 to 18%, and so on and so forth. So the lower you go, the better you get by not doing anything. And you can only improve on what the baseline is, what you get on not doing anything. By doing something, you can only improve on the baseline. When the baseline is only so low in P from 20 to 24 or 24 above, what will you even do by putting in more effort? You will not hit anything. You're better off by being in FD, by being in fixed assets, by being in bonds, in these criterias, right? You are uh, better off by taking action here, and you are the best by taking a lot of action here. Correct? So this is what makes sense. This is even in trading or investing point of view, this is what is important. And go through this chart. See, this is the entry and exit cycle. So dot-com peak, this was a peak of P's. Then 2008 GFC was the peak of P's. Then 2020 COVID, we were at 23, 24 over here, and then we went down, and then we went up again. Right now again we are at 24 in October 24. We were at PE of 24, and since then we have been correcting only. There's been no respite for any investor trader out there. See, this is the data. Dot, dot-com peak 28, pre-GFC 27, 2014 was 18. This was still bad. COVID, we were at 18. This is where we closed and started the recovery. And currently we are at 24, and we are still recovering. We are at 19.9 today on the date of this recording on 23rd of March, but we are still far from what would be the best time to be trading. I don't know if it will come tomorrow. I don't know if it will come sometime later, but it is not today. Uh, why this is important is that once the market PE is hit maybe 16, 17, and there is a fresh upcycle that starts, then you will be able to make a lot more money, and you will be able to make a lot of returns. In the down cycle, when the market is going down, it is better to avoid drawdowns, because drawdowns work geometrically opposite. A 15% drawdown will require a 100% return to break even. 30% will require a 43% return to break even. A 65% drawdown will require a 186% return to break even. This will not be achieved even in 5 years. This is too tough to achieve, provided that you have the capital left to be able to achieve this. Correct? So the most expensive mistake that people make in investing is that they think that all times are good times. All times are not good times, and sometimes it is the best time to not do anything than to be doing something. Wait for the opportunity to be right. Wait for when your batting average can be better, and wait for accumulate your capital till then. Once the situation is right, hit with full force, and you will hit it out of the park. You will get great returns. Have the courage to do it then, but don't think that all times are same. All times are not same, and sometimes you do have to wait. If there are any questions with respect to this, with respect to cycles, comment in the comment section below. Do subscribe us, do like us, and if there's anything that you would like to know or connect with me personally, you can reach out or text by clicking here on the WealthLab website as well, and I will be prompt to response. Hope you have a great day. Hope you preserve your capital, and hope you make it grow as well. See you next time.